Had a lot of ideas for titles today. First, it was like Tamed Tuesday, 100-point trading range yesterday, coming up on a holiday. We're trading a little bit higher. We're just going to consolidate here, blast all-time highs. And then I thought about tanking Tuesday as I watched Apple here. Oh, now 8 o'clock print's going off. I watched Apple sell off $3-4, giving back all those gains from yesterday. But maybe we're just going to meander here and go up. But we'll find out from Ryan Detrick at 8:35. We got one really strong stock out there. You would have had to been listening after hours to catch that one. But it's Tuesday, a synthetic Wednesday on pre-market prop. Let's get it going.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Okay, good morning, traders and investors. Let me, where are my charts? It says I'm sharing, but I'm sharing in the wrong place. Let me get them up here for you. S&Ps, we're trading in the green, but Apple took care of that. We are now trading in the red by 11.25 handles at 54.29 1/4. The dollar, a little bit of a relief rally, up 21 cents, but that's an ugly looking chart. 99.60. TLT giving back a little bit of yesterday's gains, gone 26 cents at 87.26. USO steady at 66.77. GLD up 76 cents at 296.99. SLV flat, and Bitcoin futures are up $465 at 85,630. Let's bring in the gang here. Good morning, Triple D. Are you back to Triple D? Because yesterday you were Double D.
Why was I Double D?
Brent, wasn't he like a Double D? He wasn't like a full Triple D. You were just a little
tired.
He's not packing quite. He's not packing quite as much punch.
The cold still here.
That's a funny joke, Joel.
Yeah, might be Double D still. I still have this cold. I'm nasally like crazy here. The never-ending illness just in me forever and ever and ever. Long COVID, whatever you want to call it. That's what I have. Just getting used to it. Used to living with it, but still trading. What's going on? Talk to me. What do you want to trade?
Let's start with some after-hours price action. Let's start with some after-hours price action, and we saw a doozy. It's a sense of strength in the market here. Netflix on the move.
Mr. Brentster, you got the headlines here from NFLX. This was a Wall Street Journal article, and they're talking about 2030, and the market's listening.
Did Brent freeze there?
I think he did. Okay, I'm under the pressure here now.
Month,
so
Netflix or WSJ got what?
You froze.
What?
You're
Can
back
you hear me?
now. I thought it was me. I was like, did I freeze? Did Joel freeze? And Joel was so still. He was like perfectly still. That
Is it better?
Yeah, you're good now.
Yep. Is it better?
Yep, good.
Okay, so an internal Netflix meeting last month, WSJ got a hold of some sources to talk about it. Netflix is aiming to double their sales by 2030. That will get them into the $1 trillion market cap club. A couple details here. The company is going to expand content, expand their live sports offering, and ramp up ad-driven sales. A little perspective here. Let me find this number. The Netflix would need about 400 million subscribers by 2030 to get to that sales figure. So a little perspective there. When I was going over the reasons behind the chance that they could get there, I was like not that impressed. They're just talking about expanding content, more live sports, and expanding their ad sales. I don't know. I don't know how you just expand your user base with something like that.
So
how many do
you
they
saw
have
the
now?
article, but weren't overly
They have around
impressed with
300
their plan
300
to
million.
get there. Not a lot of details in the plan. So, but it's good to have, dreams. It's good, obviously. You want your company not just satisfied with where they are. So, I like that too. this market is, ripped it up on it, and it's held up really well. I mean, the S&Ps have rolled over a little bit since then. Netflix having none of it, source of relative strength. Something that I've argued here for a while on NFL Axis is probably more tariff-proof than a lot of the other magnificent, or call them the Great Eight. Because if you go through the Great Eight, obviously you have Apple, that is very sensitive to tariffs. Tesla, very sensitive to tariffs because parts. Microsoft, sensitive for sure. Amazon, sensitive for sure. Google, Meta, maybe a little less sensitive, but Google's got Android, so it's sensitive as well. And then you have Netflix in there. Nvidia is sensitive too. Netflix sitting there, I don't think it's very sensitive to tariffs. So if you look at the relative strength, we're doing pretty good on Netflix. It's right back up to where it was on the tariff tantrum day when President Trump obviously announced all those tariffs. So it's held up really well. So is there a chance that this Netflix rally could build?
Do you know where it got to this morning, Dennis? I don't
No.
know. Probably sleeping. It's 6:30 this morning.
Where did it get to?
This is not investment advice, and I know Dennis is not going to make a wager on this like I tried to propose, and I don't think it's going red on today. Man, I think if you see 959.50 again,
That's the high.
that's the high. Whoa. Okay. All right. That'd be a nice target on the upside. I'm not going to get old bearish on you and tell you it's going red, but that was overdone, and it was a great discussion in the STN room about it too. It was like we had a participant was like, "Well, they're trying. Do they know if they're going to do it? How are they going to do it?" It's cheap, right? How much is Netflix? Is it like $7, $10? How much is it? I don't even know. How much is it a month? Do we know?
You can do two tiers. First tier is advertising tier, which I think is like $5.99 or $6.99 a month. So that allows them to give you advertisements. If you do the non-tier advertisements, I think it's like $17.99 a month or something.
I think you're right,
It
Dennis.
is cheap. I mean, I have Netflix. I mean, they're always coming out with new content. They're always coming out with good stuff. I mean, it's pretty good. So I don't plan on getting rid of my Netflix anytime soon. But I did get rid of Disney Plus because one, the content was fine, but they just never had any new content. We talked about this. So I'm basically a Netflix household here. Prime's good too. I've talked about Prime being a competitor, but Netflix still leading the charge here, not going away streaming, best of breed, kind of everything you want in a stock. Valuation, has never been cheap on this thing, but it's not at a point here. Let's just go and look out up. Sometimes it's fun to just mix in a little fundamentals here too, because technicals, are good. Fundies are good too. Forward P is 37. It's not insane. Lots of the Great Eight is, lower 30s or upper 20s. So it's got a little premium to there. But, I mean, if they're planning on expanding earnings and doubling revenue by 2030, there's a growth story here all of a sudden.
It's cheap.
Can they hit those targets?
Yep.
Maybe. Day by Day canceled Netflix. Day by Day, why did you cancel Netflix? Mr. Desto says it's $26.74 with the tax. Is it?
Maybe that's Canadian.
Well, I'm Canadian. I didn't know it was that much. I don't pay attention to my bills. Maybe it did go up.
Last week we had a few people in the pre-market prep chat who were saying this is like non-discretionary spending. This is like I'm hooked. I've been hooked for too long. There's no way I'm canceling my Netflix no matter what happens.
Kind of just interesting, there. Is it a staple?
Yeah,
that's
exactly
what you're asking.
Yes,
is
exactly.
Netflix a staple?
Yes,
maybe. What are you watching if you don't have Netflix? Like everybody's cutting the cord. So we've really gone from like everybody had their cable TV, direct TV, Dish Network 15 years ago, 10 years ago even. People have said, why am I paying $100 a month for cable TV or $80 a month for cable TV when I can subscribe to like 3 or 4 of these streaming services, get way more content for half the price? I think that's where we're at. Even if it's 26. Premium is $24.99, Bill's telling me. So even if let's say $25 a month for premium, it's still a hell of a lot cheaper than Comcast.
I that.
I guess when you package it in, sometimes, if you package it with your internet, you can get it not bad. But it's, the one issue has always been sports. Why I don't cut the cord has always been you want to watch your live sports. So if they start getting more of that over there, and they're obviously trying to do it.
Well, that's
Prime has
content.
NHL
That's
Wednesday
expensive.
night,
And
so
sports are
they
expensive.
need sports. It is.
That's
Sports are super
expensive.
expensive.
Yeah. Should we do the BMY real quick because just sticking with what we covered in the STN room last night, shrugging off the bad news here.
Yeah, I can do it
Um,
quick.
yeah, real quick. News me on Bristol Myers.
Bristol Myers had a trial that they were working on. They reported last night that they did not meet the dual endpoints for the trial. So we did get a little move lower initially, as far as I'm remembering, but the stock's up like a good percent right now. It was a phase 3 Odyssey trial for symptomatic New York HA class 2 and 3. If anybody knows what that is or cares what that is. I'm sure somebody cares what it is, but
Sold straight off last night. We did cover this in the STN room over at Stock Trader Network. 51.34 down to 49. Joel popped out with the level and saying, hey, look, if they're going to make a stand, it's right here, 48.82. I popped in and said, usually when you get a Bristol Myers, a Merck, a Pfizer, report one of their trials, they don't usually sell these stocks off 10, 20, 30%. These are not one-trick ponies. These are major pharmaceutical companies that have so many tricks in the bag. So it's usually like a 2, 3% fall. So that coincided nicely there too. It's popped back, not to 50, 51. It's barely down here now. So buy the dip again works on Bristol Myers last night. I mean, we're still in this market too, where if you are chasing on both sides, so let's just go back to the overall market and cover in that context. I think I covered Bristol Myers levels pretty good. If you are chasing on both sides, you are on the wrong side of the trade more often than not. Why? Because look at Apple yesterday. Let's just go back to Apple and talk about the Apple price action here, Joel. Because you had the huge pop in the open. We talked about it on the pre-market prep, and I was like, well, I'm not chasing this up. There was, the rumors. We don't even have any, official announcement from the White House here, but that's, over the weekend, that smartphones were going to be exempt from the tariffs. Then the White House came out and said that wasn't true, but, we've seen White House say, no, it's true, and then it gets announced 2 days later. So I think the market was calling the White House's bluff and ripping it higher. As the day progressed, and there was still no real news on is there exemptions here or not, are they going to be a lower rate or not, Apple started to leak. So again, chasing does not pay. Say it again. Chasing in most markets does not pay. In 2020, absolutely paid. 2020, when people were coming out of COVID and learning how to trade, they're like, oh, you just buy the stock that's up and it just goes up more the next day. Yeah, 2020 was very special for the bulls. It was a year where everything was just, after March, everything just went straight up relentlessly. That is not normalized markets. You get moves up, moves down, trends, buy dips on stocks and uptrends, sell rips on stocks and downtrends. Those strategies all apply. They apply very much so in this market that we're currently in, which is the contrarian's dream. So all of your momentum strategies, you've got to adjust. And that's where we're at. How do you adjust? Well, you take the money and run. You get your 4, 5, 6% pop. Don't hang on for 12, 13, 14% because it doesn't usually in this market seem to go that way. It seems to go more of the way that, oh, we give it back. So I think we remain in that market where you're going to have violent little oscillations, obviously driven by news coming from the White House. And I think people are just spooked a little bit still, for like, oh, stock goes up 10% here. Is it going up 20? I don't know. And again, Apple is a classic example of the market that we're in 2025.
I try and last week when we had all the volatility and things, and Brent's like, oh, you're being positive, and I really try and keep a positive tone on the market, right? This chart and this price action really concerns me.
Why?
Because it's like the market doesn't believe what's coming out of the White House right now. Either they don't know what's coming out or they don't believe what's coming out. And for this stock to pop up like this, give this back, it'd be trading lower today. It's not back to Friday's price. Friday's closing price was 198.15. This is, things aren't getting better with China, and maybe we could go to the Boeing news yet. But when you have, their entire supply chain, and who knows where this is going, but until it is officially off the table, that Apple can, they're not going to make this transition. This is such a big thing. 14,000 employees, 1.5 million people in the supply chain. You don't pick them up. You don't move this overnight. So this to me, if Apple number one component in the S&Ps, this is concerning to me. There's a big rebound in the market. We're up near last week's highs. I mean, I'd feel a lot better if this stock was flat or holding on, but I don't know. It's concerning for the stock, and to me, it's concerning for the overall market.
I think we're just waiting for clarity here. And I think the market, it's not a matter of not believing the White House, but maybe more believing the leaks from the White House, because we saw the 90-day tariff. The White House lost a little bit of credibility when the 90-day tariff thing came out on, last Monday, and the markets rallied like crazy. And then they came out and said, no, this is not true. And then 2 days later, it came into effect. So it's like, well, what do you mean it's not true? Then 2 days later, you implement it. So I think you're right, Joel. I think the market doesn't know what to believe right now. It doesn't know to believe the media, doesn't know if it can believe the White House, doesn't know if it can believe on tariff exemptions here, doesn't really know. And I think it's more of the case that the Trump administration doesn't know where they're going. I mean, obviously a lot of uncertainty, because we came out when he put all these tariffs in and said, these are going to be here for the next 4 years, no matter what. A week and a half later, there's a 90-day, kick the can down the road, and now we have to reevaluate. It's like testers, man. They don't really have, they want to put tariffs in, but they don't want the market to go down. You can't have your cake and eat it too. Trump was hoping he could. I don't know if he can. The commentary yesterday wasn't over, as Trump had said, the market rallied because they're getting used to tariffs. That's what he said yesterday. Well, the market didn't rally because it was getting used to tariffs. It rallied because he said there was going to be possible exemptions. So they're not used to tariffs. They rally because you pushed it 90 days down the road. That's why the market's rallied. So Trump wants the market to accept tariffs and wants the market to go up while he implements tariffs. That's not going to happen. So what does Trump want more is the case. Does he want these tariffs in and going to accept the market falling 20, 30, 40%? Or
50.
Does he want the market to stay up near highs, which he's used as a benchmark before, under a lower tariff regime? I think it's the latter. So I do think, that they're not going to be doing all these tariffs that they did 90 days ago. I think he got spooked by the bond market, spooked, somewhat by the equity market, spooked somewhat by Jamie Dimon. And that's why this market dips are getting bought here now, because they're kind of calling the bluff and saying, look, I don't think the tariff's going to be that bad.
Well, let's go to Boeing. I mean, they're China in the crosshairs. Boeing trading down. We haven't talked Boeing in a while. Trading down almost $6. China doesn't. They're telling their airlines no more deliveries of Boeing. That's some bad news after a nice rally here. So down 549. I don't know what percentage of that is of their backload, but you match the high from last week. I mean, Boeing, once it gets going one way, it has the hard time stopping, coming down 563. So Boeing taking it on the chin again here. What kind of move did we have?
But I'll take the other side of that. Same damn market we're in, Joel. Same market we're in. Uncertainty. We get a cancellation, but maybe there's a trade. We'd had good talks. There's so much whipsaw and overall action here. We are still in the contrarian dream. So I absolutely do not come in and say, I'm short Boeing today because it's down 3.5%. That's going the exact same thing as buying Apple when it was up 5% yesterday. Same trade, opposite. Start thinking more like a contrarian and not a momentum trader. That's what
I'm not going to be a contrarian in Boeing. I'm not shorting it. I wouldn't be happy if I'm long in it.
We could say, it's just been a disaster, and it epically has. But look at the last 2 years of this chart. It's the same spot it was 2 years ago. So if you're always selling in the hole and buying on the rip, you're losing a lot of money. If you're always buying on the dip and selling on the rip, you're probably making money, because when you're in a range, buying on the dip is the way to make money. Selling on the rip is to make money. This market remains a contrarian dream here. I'm not necessarily saying come in here and buy Boeing down 3.5%, but I'm definitely not selling it. I'm not saying short it. I'm not initiating a position, try not to like, for everybody listening to this show, you've got to, it works both ways here because momentum, people naturally just think long, okay, well, I'm not going to buy the things up. But if it's down, don't short it either, or don't, start selling in the hole. These are stocks like even Apple today. There could be something coming from the White House. The 200 support on Apple, you're right there right now. So I'm not going to say Apple's the end of the world and we're going back down to the lows. Just keep an eye on obviously whatever's coming out of the White House, but I think we still need to remember the kind of market we're in, and that remembers the contrarian dream. It's the best contrarian market that I have seen. That's the statement right now. 26 years of professional trading as of May 1999. I don't know if I've ever seen such a contrarian dream, where it seems like it has no memory. We rally 5%, then we sell off 5%, then we rally 5%. So, I mean, if you're struggling this year, it's you. If you're a trader and not an investor, all investors, I'm down on my investment account too. S&P's down 7%, you're down. But if you're a trader and you're struggling to make money, check your strategies and see if they're just full of momentum stuff. Because if they're full of momentum, you're going to struggle. If they're full of contrarian strategies, you're going to do a lot better.
Well, well, first of all, our alpha said he's at 136. I think that's a little bit low for today. I looked at Boeing. I would say 146 is halfway back of the recent move. That's $6-7 away. Just looking at potential support. But Dennis, if you are being the ultra contrarian, okay, for the year, and I'm just looking, then we hung out. The trend is down. You've had a huge rally. If you're a contrarian, then you're just, to me, you've had a huge rally based on nothing. You gotta be cautiously selling. I'm not saying shorting or whatever, but I think this rally, I just think this is such a gift here when we continue to hang up here. So I'll go with your contrarianism, and I'm saying, being a bull here, man, you got to be either a cautious bear or, I don't want to say perma bear because there's no perma bears that make any money, but I think this is a gift rally up here. I don't think any way you look at it, and that fits with your contrarian because we rallied 700 points off that low from last Monday.
Yeah, I'm not adding any stocks to my long-term portfolio, but again, you can be contrarian within the contrarian. So, it depends on your time frame. I would argue you could be contrarian on all time frames right now. Like we just sold off in the last hour 20 S&P handles. Well, I'm not coming in here and selling stocks right now. Let's get a little pop back up on, it's because if you look, it's all about time frames. Right now, contrarian's working on every time frame, every single time frame. Just whipsaw action throughout the day. Whipsaw action throughout the 90-day. It's just working. How do I know it's working? My P&L tells me it's working. I've been preaching contrarian strategies all year. It's the best start to a year for me in 3 years.
All right, let's pick it up. Let's pick it up with some earnings. Let's go to, we didn't have anything after hours. Let's go to the most recent one. Citigroup. Citigroup here beats 196 versus 184. Beats on sales 21.6, 21.29. Banks have been doing okay. I mean, you can't complain about the earnings from the banks in this quarter. Citigroup getting a pop, giving a little bit back here.
In the middle of nowhere.
Okay.
I mean, sometimes it's just trades, but go to your 90-day. This is in the middle of nowhere. So 70 was where you broke down from. 55s is where you just bounced from, going out farther. The earnings are pretty much meaningless. There's a beat, but nobody cares. It's not even moving. It's 50 cents. So just overall, 70, major resistance up there. 55, I can buy 55.
I can drive.
55. That's where I'd be a buyer, City. Staying within range.
Let's see if we can gap fill down to yesterday's low 62.70. You're well above that. Gap fill at 62.31. That's your support. And coming back yesterday's high. Not too far away either. 64.43. Bank of America trading up 46 cents. So let's get BAC out of the way. 90 versus 81 sales beat 27.4, 26.99. Global deposits grew, was that 1.2% year over year? The rally continues here, but off the pre-market high. So, and that has not hit last week's high either. So big number, just under 38. 37.86 was the high from last week in Bank America. Dennis, any comments on Bank America?
Same thing as Citi. Broke down from $41 on tariff tantrum day, bottomed at 33. Half of that brings you right into this range, 37. So it's pausing, right at where you'd think it'd pause. Earnings don't appear to matter because the stock is hardly moving. Just waiting for the next White House. It's like the market is just waiting for the next headline. The technicals, you can analyze it all technically, every single stock. The market is literally just waiting for the next headline, though. So I think that's, I'm doing the same thing. I just sit there. I'm like, Brentster, where's Trump speaking today? Brentster, is he saying something? Every time we get a move, Brentster, what's going on? I mean, that's all that matters. We still stay in that same market. I don't think anything. I think the story remains the same.
So Johnson & Johnson, we care less about Johnson & Johnson. That's in the middle of nowhere too. After its earnings beat, 277 versus 260. 21.89 versus 21.58, pulling back here. Still a lot of issues here with Johnson & Johnson. So, man, a lot of the charts look the same here, but Johnson & Johnson giving some back today. Let's see
It's
if it's
come a long ways back from the lows here too, and I'm with Joel overall here. No stock is entering my long-term portfolio really right now. If we pull back a little farther, maybe. But J&J's bounce back. It was 141 3 days ago when they had the asbestos, nightmare starting again. And people are like, the market just forgets everything. And the market's so dumb. Just completely forgets about that. Oh, yeah, we don't worry about that. That was 2 days ago. Now, that's a problem for years. It's going to be a problem for years. So as the stock gets up to 155, 160, it's a sell. It gets down lower 140s. Maybe it's a buy. But, I've always been nervous. I just don't know where they're going, and how they're going to get out of it. They keep thinking they're going to get out of it, and then they don't get out of it. It's a never-ending headache for J&J. I don't think this is the defensive stock that I want to be in.
Boy, look at this trading range that it's been in. It's well below the lows from 21, but man, this is kind of scary here. What was the low? 140. I mean, that's been a trading range that's held since the end of 2020. You're still 10, $12 away from it. So that's a look at Johnson & Johnson. But Dennis, be honest. I know you. There's one stock you're looking at in your portfolio on a pullback because you're bullish and you're bullish Webull. Trading down 920 today at 53.70.
Man. The market is so bloody, just crazy. It got to $80 yesterday at $80, and we were trying to hunt down like what the actual market cap of this company is, and there was conflicting opinions because the float is so low. But then when you look at the fully diluted, when they get everything out there, it's a hell of a lot more market cap than you think here. And somebody was saying, and I believe it's correct, that this was trading, it's still maybe trading at a $30 billion market cap here. Robinhood's 35. So at $80 yesterday, I believe, and correct me if I'm wrong, for a short period of time, Webull had a higher market cap than Robinhood. That is absurd. That is absurd. Absurd, absurd, absurd. Stocks, trade on story though. People didn't even know about it the first day. Then they found out the second day, like, oh, I trade there, I want to buy that. I trade there, I want to buy that. And you find out, and it's a China company too, so it's hard to find out financials or anything. We were trying to do in the SDN room for 20 minutes analyzing it all. We finally figured out about the market cap that there was all those diluted shares because somebody was saying, oh, there's only so many shares outstanding and this market cap's really low compared to Robinhood. That was not correct. The stock actually has, when you're fully diluted, its actual market cap was approaching and maybe even surpassed Robinhood at the peak yesterday, which is insane.
You know what? I have a
Story's
vision.
hot, but where this party ends, I don't know. I'm not putting this in my long-term portfolio at a market cap just under Robinhood. That makes no sense to me whatsoever.
Dennis, do you want to know what your biggest money maker is going to be for the second half of 25 and 26?
Please.
You're going to trade the Webull Robinhood spread pair.
What do you think about
Okay.
that, Dennis?
I probably will eventually be trading the Webull Robinhood spread. Not yet, though, because it makes no sense.
Oh, not yet. Not yet.
Let's
Not
go. Let's just look here. So outstanding shares, Brent. We were doing this yesterday. We had to figure it out, and I forget very quickly because I'm old.
Okay.
My goldfish memory doesn't allow me to. But I think outstanding. What did we come up with yesterday? How many shares were outstanding when we were figuring out fully diluted? Was it like 500 million or something?
Yeah, I
Did we
think
come up
so.
with
Yeah,
that?
don't quote us on that, but yeah, it was.
Yeah, and it was hard to
broken down
find.
bill. It was really think about it is saying 543.3 mil. We don't have we didn't like get any new data on this like overnight. Just to say that we have a question. We were all going off of the stuff that we were finding in the company's S4 or F4 filing, which is their like initial IPO SEC filing. So if you do want to dig into this a little bit more, go find that filing. It's like 300 pages. There is a lot of info in there, but you really got to dig through it. And this is totally normal for,
Yeah.
especially a foreign IPO.
I think we found 544 million. Yeah. So 540. Let's just round it down for fun and just say it's 500 million shares.
Okay.
So we can do easy math on that. $54 means it's got a $27 billion market cap right now. Robinhood's current market cap currently, which is definitely best of breed, is 39 billion. So when it's hit 80, it actually touched Robinhood's market cap. It was actually for a moment in time worth more as a company than Robinhood. Webull, sure, lots of people trade there, good company. Not even close to the size of Robinhood. Not even close.
I think we're a little. I mean, we're probably a little jaded just being in the U.S. I don't know how many. I don't know how many Chinese people trade in general or use Webull. Is it totally like a U.S. / Western world thing?
I don't know, because
sure.
we went
Something
and
to
tried to
consider.
find we tried to find revenue numbers, and that wasn't easy either. So I mean, when you have these China companies that are out for 2 days, the numbers are not easy to find.
Mm-hmm.
So it's even hard to figure out comparisons and stuff. Like we got good metrics for Robinhood. 39 billion, trades 32 times earnings. I mean, reasonable. I'm assuming Webull doesn't make money. We first found out, so it does not make money. So that makes Jared's saying it does, but it was like it didn't in the last year when we were analyzing it. So it makes it a little bit trickier when they're China because you can't get a good feel on all the numbers. But my experience, maybe Webull's way bigger in China than Robinhood is. So there's an argument there, Bradster.
When we looked at the financial statements from the F4 filing, we saw that they made money in 2022. They made a lot less money in 2023. They had not made money. They were reporting a net loss in 2024. Maybe there were some adjusted figures there. And then for like the first 6 months of last year, they were making a little bit of money. So it's kind of a little back and forth here.
I think they chose the wrong name at the wrong time.
Are you gonna say they should call it We Bear?
Yeah, We Bear.
Saw that one coming.
And then the other thing, before we go to our esteemed guest here, the other reason I would be cautious on this one is I just looked at the last couple IPOs and WTF it's kind of come back. Good support at 6. And then Newsmax. I mean, if you bought that at 260, you're kind of shaking your head. It's up $1.30 today at 27.30. And then I always get it. CRWV. I mean, it's
you got it.
Wild ride, but that's it. That's where I'm at on that IPO there.
But Joel, I think it is important to note here. We got some interest in Webull, an IPO, and then look what happens. Some of the other recent IPOs started popping back up. So just remember that happens, folks. It totally happens. It's totally a thing.
So you are making some fantastic points, and some people in the chat are making some fantastic points. And I did not know that Webull had 20 million accounts. I didn't know it was that big. They're telling me Robinhood is 21 million. So when
you-
I'm looking,
so
it's
just
just
on
coming
that.
in there. So it's actually, I thought Robinhood was a monster compared to Webull, and I'm being corrected here. So I'm not saying
I
I
just
don't
want to know
know.
the average account size. I want to know the average
Yeah, I
account size.
don't know any of that.
Okay. Okay.
So, but I'm
Let's
just
go to
looking. I'm
Statman
using
Do. Let's
Google
go.
AI. Google AI says there's 20 million accounts on Webull and 21 million accounts on Robinhood. So it's more comparable than we thought. So obviously, I guess when this thing was trading yesterday morning or the day before at a market cap of about 7 billion only, maybe that was way too cheap compared to Robinhood. I still like Robinhood, and I think Robinhood's best of breed. And I do have metrics where I can understand the earnings and everything too. So I think Webull trading over market cap of Robinhood, I'll still say is overdone. But maybe down there when it was at 17, 20, 25, maybe it was way
Dennis, let's go
undervalued too.
from we bull to our bull.
Please.
Okay. Ryan Detrick, Chief Market Strategist at the Carson Group. Let's talk strategy here. Ryan, how you doing today?
There, had to turn myself off mute. Doing well, busy morning. I see some red. We've had a little green. We got a lot to talk about, but how you guys doing? Everything good?
Well, we like volatility. I mean, when you have a broadcast, pre-market prep show that does best on down days, I guess it's an indication of but we want your view. They've been hearing us opine here for 37 minutes here, Ryan. You come with the stats. Stats don't lie. Where we at? Where we going?
Well, let's see. I threw a bunch of stuff together here this morning, so let me just make sure I'll share my screen. Give me 1 second here. I think it's this one.
Do you get to share your screen on CNBC?
No, that's okay though. No, my job on CNBC is just go on there and don't screw it up too much. I say I don't want it to be memorable, because if it's memorable, it probably means I did something wrong. I mean, I've done TV a lot. I think I started 20 years ago. I'm trying to think, Joe Kernan one time, he asked me, what's your favorite restaurant? Honestly, I froze on TV. I had everything under the sun ready to go, and they threw me a curveball like that. I'm a little better at that now, but anyway, yeah. So,
wait, can we talk about when Dennis went on CNBC?
Ooh, I didn't know this.
My earpiece fell out. That was like a lot of years ago. The earpiece fell out on me. I couldn't hear what they were saying. I looked up and I was like, what's going on?
Yeah, I mean,
that was a disaster. I never got invited back.
Well, yeah,
that was the end. You can't have something like that happen.
No, I mean back in the day,
pop up like this.
Hey, talk about productivity. Back in the day, you had to go to the studio an hour early, and then you just get bumped by the president. Now I just roll out of bed, go to my basement, push a few buttons, and away we go. But away we go. You guys see tried to warn you, right? You see that? I hope.
Yes.
Perfect. So this is playful, yes, but I saw with you around the Super Bowl, and we said, well, you don't want a team from Philly to win, because when teams from Philly win, bad things happen. There you got the Athletics a few times in the 1900s, Panic of 1910, 1911, obviously World War I, the crash of the Great Depression. You got 1980 in there. You got financial crisis in 2018, obviously one of the worst years for stocks we've seen in a long time. All when the city of brotherly love wins, and sure enough, here we are. Our friends in the city of brotherly love won a Super Bowl, and it has been a rough go. So that's playful. I think I've shared this with you every time, so I'll just keep sharing it. The first quarter of a post-election year, obviously where we just were, was obviously very, very rough, but that wasn't totally abnormal. You can see on all 16 quarters on a 4-year presidential cycle, that first quarter is one of the weakest. So, I get it. I mean, news trumps charts, keyword being trumps. We get it. One tweet obviously is changing a lot, but still, after you gain 20%, the first quarter tends to be a little weak. The first quarter of the last 20 years hasn't been all that great. And then you see this. So it kind of added up. I mean, we came into this year, yes, overweight equities. Yes, expecting the S&P to gain between 12 and 14%. I know that's a mile away right now. In our unconstrained tactical models, going to get a little geeky because we do manage money. So we're not like short-term traders, right? We manage billions of dollars, so it's hard to do short-term trades. I wouldn't want to do that. But we were like 91% equities on our unconstrained models back in 23 and 24. You guys know I came on a long time saying bullish. We actually cut that back on March 3rd, and we cut a little bit more. So we're about 74, 75% equities now. Yes, still overweight, But again, I live in a world where like if you say you manage money, you have to own equities, right? You can't just go all to cash. I mean, we have to have 60% in this model, 40% here, 80% here. It's just the world that I live in when you manage money. But we've done some things where we're not just all in U.S. equities, right? We are. We've got U.S. equities, but we've been adding international developed. We started doing that late last year. We've added treasuries. Now, I get bonds have just been crushed the last week or so, but still added some diversification there. I'm going to show a factor play a little bit. One big thing we made a big bet on earlier this year, and it's been working out well. So that's just some context around it, but we are still overweight equities. Yes. Some opportunities. No, we did not see a near bear market. We said between 10 and 15% made sense. Some peak to trough correction. Probably come on with you guys saying that was possible. And then sure enough, we all had pretty much a bear market. So no, we didn't think that would happen, but also we didn't think the tariffs would kind of spiral like they have, and it's where we are. So so with that out of the way, this is our Carson quilt. I'm sure lots of people have seen these. I guess the bottom line, it was updated maybe as of a week ago or so. But, growth was the top performing sector of the last 2 years. We all know that large cap, right? We were more neutral large cap tech. We said the bar is awfully high, and just glancing at it, it's hard to be the top performing group 2 years in a row or the worst performing 2 years in a row. It can happen. Don't get me wrong. But I think, this is good for investors to kind of look at these and remember, and working with financial advisors like I do, looking at longer term investment strategies, maybe not so many traders on this call, but to just be aware that shiny object, I see it so many times with clients. Oh, tech's the best group for 2 years in a row. I want to go all in on tech. I mean, that's where you got to really look at your history here to realize that's probably not the wise thing to do. So it's just kind of interesting how tech's literally, or growth, I should say, literally the worst performing sector after being the best 2 years in a row. That isn't a shock to us to see that. So the bond market remains undefeated. You probably use this quote. Carville this week said, this week, he said it in 1993, but it was about last week when guess what is today? Tuesday. So yeah, so a week ago today, right before midnight Eastern times, when the 10-year yield spiked almost to 5%, or maybe it did intraday there before midnight, before the tariffs went into play. Anyway, and he said, I used to want to come back if I was reincarnated as a pope, a president, a 400 hitter. Now I just want to come back as the bond market because you can intimidate everybody. I think once again, President Trump, there's a great article in the Wall Street Journal that looked at the idea that he was okay with the bear market, maybe even a minor recession, but not a bond market debacle. And we were seeing that, right? We started to see that. We can get into it. We're still seeing some issues with yields. But anyway, so it's kind of interesting. The bond market remains undefeated. This is last week's story. I think the big story clearly is the yields going higher and the dollar going lower. In periods of stress, when everything's falling apart around us, that's pretty much never happened before. I mean, usually it's the opposite, right? People flock to the safe dollar and safety bonds. So believe me, I don't know what this means necessarily. I'm not supposed to say I don't know what it means, but we do know that's what's happening, right? And again, as investors, what can we do about it? Well, we don't expect yields to break out. I mean, I know they pulled back some from where they were this time, I guess 7 days ago. But, the weak dollar, I mean, if you have a weak dollar, that was one of the contrarian calls we had coming into this year. We've got a 4% allocation to gold, and I get it. Gold's just soaring, right? So we added gold to the first time in our tactical models, March of 2023. You guys know I was pretty bullish, but I'm probably shared a chart or two over the last 2 years showing this, but we thought gold and stocks could probably do okay together. And fortunately, that's played out. And I look at gold kind of like an ulterior play to bonds in that 40%, 60-40, that 40% side. So that's how we've been looking at that. But again, this is a real unique situation. But when the dollar is weak, plain and simple, commodities do a little bit better. At least gold does a little bit better because obviously oil hasn't. But in general, gold does better. And honestly, international investing does a little bit better. We have over a 20% allocation, I think, to international exposure in the models we run. That's a lot more than a lot of people. If you talk to financial advisors, I promise you, most people don't have over 20% allocated to international. Specifically, we added some more European equities just last week. And I can't probably mention ETF, but a European ETF. We think Europe is an area that maybe if you're a diversified portfolio, you can still get some safety, if you will, and diversification, and honest to goodness, maybe some continued outperformance. My friend Scott Brown shared this. It's a ballpark of a washout, just the stocks of a 50-day, 20-day, 200-day. I'm sure other guests have shared something like this, but we're in the ballpark, right, of hopefully well, really a week ago, I guess on Monday, we came in and the world was crashing, right? And we obviously, maybe someone pointed this out, but last Monday was the first day since May of 1970 where the S&P opened Monday morning down 2%, but closed the week up over 5%. So reversal from Monday through Friday. The S&P gained, I believe it was either 46% or 56%, like over the next coming year and a half or 2 years, something like that, after May of 1970. So that was a big moment. Sample size of 1. I get it. If there were more sample sizes, I'd share it. So that's just something to think about. This just came out. The Global Fund Manager, Bank of America Global Fund Manager Survey. It's always a mouthful to say. Not too surprising, but let's just glance at it. Honestly, I haven't looked at it too closely. I just threw these in here. Expecting a recession. You can see the 4th highest in 20 years. Now look at those dates. I mean, March 2009, April 2020, November 22. Not great times for stock market or the economy, but they weren't the worst buying opportunities. Let's just remember that. Surge in cash, not a shock. Obviously, people are worried. And then the big one at the bottom there, record number of global investors intend to cut U.S. equities. I mean, just huge. I tweeted it, and it went pretty viral. It wasn't a normal tweet I do, but just the number of Europeans expecting to visit the United States is just dropping. Maybe not Europeans. Maybe it's all around the globe. So clearly, we've got some issues, with how the rest of the world views us. At the same time, I guess that inner contrarian in me kind of likes to see some of these things, even as uncomfortable as it has been. Bounce, the 48.20 level was the previous peak in early 2022. Also a 50% retracement from the lows in 2023 to the peak earlier February of this year. So that was a big level we've been looking at. I've been looking at them. I'm sure you guys have been watching that too, that we want to see the previous peak back in early 22 hold. Fortunately, we did so far. We've had a pretty good sized bounce off those lows. So that's some minor encouragement in a sea of negativity. I love this. I know you talked about it. President Trump says it's a great time to buy. A couple hours later, the stock market had its 3rd best day since World War II. Yeah, there you go. He got that one right. So
what's the history of that? How many times the president says
Yeah,
it's a
come
great
on,
time
Ryan.
to buy?
Well, he probably does that a lot. I don't know, but it worked last Wednesday. I was at a doctor's. I had a doctor's thing. What was I doing? What doctor was? Anyway, the doctor. And I go in and I walk out and I'm like, what? Like up 8%. My phone's going nuts. I was like, what in the world's going on? Oh, well, there you go. Got some good tariff news. Anyway, 23 times. I should go to the doctor more often. Good things happen. Anyway, 23 times the stock market, the S&P 500 gained at least 5% in one day. And you can see the next day and 5 days later, not that great. Normal to get some consolidation and things. But then you go out further, 6 months, 12 months later, you're looking at some really good returns up 91% of the time. I get it. A lot of these are clustered. I get it. These big bounces happen in bear markets. That's absolutely true. One of the things we've been stressing to our clients and our advisors is the best days and the worst days usually happen close to each other. I've seen it 1,000 times in my career. You have the worst days and people want to sell, and then you have the best days. So like what we're telling our clients is now, if you were a little edgy, we're up over 10% from the lows, well over 10% actually, from those lows. Maybe now you kind of, if you want to do some tinkering, but to sell in the midst of the worst days isn't always a good strategy because you're usually going to get a bounce. And as this shows, the best days, near term can be still choppy, but it is what it is, right? A year later, you do better. Now, this is really interesting. April 9th might go down in history as a day that was really significant. We know that. Gained 9.5%. Okay, that's fine. Let's peel back the onion. Make sure I read it right. 98.6% of all the volume on the NYSE was positive. I've got data back to 1980, thanks to Ned Davis. Research. Never has a day been that strong in terms of up volume relative to down volume. It is what it is. There's I call it, what do we call it? Buying thrust, sellers go on strike, whatever it is. And again, you can just see previous days we saw ballpark what we just saw. The August 82 lows, March 2009, a couple times in 2010, 11, 12, all pretty good buying opportunities. So Wednesday was really rare because everyone's calling it a bear market rally, it feels like, and that's how these start, or it's a short covering rally. That's how they start. But again, that was so darn strong and extreme that's interesting. I'm sure I'll get to come back with you in about a month or so. We've got a potential Zweig breadth thrust taking place right now. We'll get into that in a month, but we're very oversold, and with a little more rally, we can get kind of near-term overbought, which can be a real positive development. Just a couple more. So bad it's good. That's CNN fear and greed. There's lots of ways to look at market sentiment. I get it, but that's down around 3. That's where we were in COVID. That's where we were at some previous major lows. And the VIX spiked above 50. Actually, it was 60 on last Monday. But you can see again, when the first time the VIX touches 50, that's one of the better buy signals of my career, is whatever's going on is probably scary and it's probably really bad. But when that VIX hits 50, you see the numbers there. It tends to be kind of a positive development looking out 6 to 12 months. And again, we're about 74% overweight equities. Trust me, I wish we were at 50% in our unconstrained tactical models. But again, we've done some things that I'm pretty proud of how we position it, and we really killed it the last 2 years, being really overweight equities, and a lot of people weren't. So it's hard to kind of move that cruise ship really quickly. But I think we're doing a pretty good job. And when I see things like this, I'm pretty comfortable still sitting about 75% overweight equities with some of these numbers that we're seeing with an economy that struggling, yes. Going into recession, I mean, we'd say recession over the next years, maybe 35%, a lot higher than it was 2 months ago, no question about it. But again, what's priced in, what's not priced in, there's a lot of bad stuff priced in, and we like that. This is interesting. We almost had a bear market. That's 20%, and I get it. I'm sure all the listeners want to pull their hair out. Well, what's a bear market? Who chose 20%? Do you use intraday versus close? I get all the flaws in this. I'm using closing data. Got to pick a number somewhere. On a closing basis, we were down 18.9%. Check it out. Since 1990, 4 other times we had a near bear market, down about 19%. Just something that's interesting, in my opinion. Also, recession versus non-recession there. When you have a recession, you're down, 35% on average versus non-recessionary bear markets, about 24%. That's right where the 22 bear market bottom. I remember talking about that back then. If you're not in a recession, which we didn't think we were in late 22, and that wasn't very popular, you're probably going to bottom around now, especially in October of a midterm year and all that stuff. And that sure enough played out. Just a couple more. So what are we doing in some of our models? The billions of dollars we run for our advisors. One of them is we're doing a kind of a paired trade, a hedge trade, if you will, playing offense and defense. We're looking at momentum and low volatility. So we're doing we got almost a 20% allocation to momentum and low vol, kind of a barbelled approach, if you will, because and the numbers are the numbers. Now this might have been as of a couple weeks ago, but the reality again is doing 50% low vol and 50% momentum. You've got some offense in there, you've got some defense in there, and honestly, you've got some big time outperformance relative to just the S&P 500 with less volatility. So you call it a factor play, if you will. We're not huge in the factors, but the idea of this low vol versus momentum as kind of a paired trade is a nice way to benefit from potential volatility, but also not do as poorly and get the upside. Made a lot of sense to us. So we started getting into this trade, I don't even know exactly when, late last year probably, and it's really, really helped some of the things we've done. Just a couple more. What if we go into a bear market? I updated this the day of the lows, and sure enough, that marked the lows. That Contrarian indicator was strong. But when you close down 20% from the previous high and you simply closed your eyes, held your nose, and bought, well, there you go. I mean, the times it was down were significant, generational bear markets, the tech bubble and the GFC. If you're not in one of those scenarios, and I get it, it can still get worse. We understand that. You can see the returns there 12 months to 2 years later. Fairly solid. So just some things and the way to show that is, check out the median. The median returns obviously much better because your averages are skewed by a couple big negative ones. It's almost done. I swear, I keep saying that. And I got more charts. Almost done. It's earnings season. The honest truth is it's very muddy, foggy, whatever you want to call it. I shouldn't say loved what Delta said, but I thought it was interesting what Delta said last Wednesday. We don't know what's going to happen. We're not giving guidance. Stock goes up 23%. Now that was because of the tariff news, but still, I think a lot of companies are going to say that. But it is early. What the financials have done so far is really impressive. We'll get to the big names next week, and what could spark a continued rally. Just the fact that earnings might not be great, but they're still better than what people are saying, and that's a positive. And then again, if you look at multiples, which we consider technicals, fundamentals, and valuations, but honestly, valuations not quite as much, especially in our tactical models. Valuations have come back. Well, we've also just had a bear market. Now, the E part of PE is very uncertain right now, so we're being clear, but we're anxious to see over the next couple of weeks what corporate America has to say. Credit spreads, I'm encouraged by the fact that spreads are not above where they were in 22. Yes, they've gone up a lot the last couple of weeks. We've got various credit spreads on the screen here. But I guess there's two ways to look at this. Spreads are up a lot the last 2 weeks, or they're not as expanded, or they haven't expanded as much as in 2022. So credit's not as worried as it was in 2022. Maybe that's a potential positive. And spreads have come down a good deal the last couple of days. So that's something that's important. This is the last one. Just a big picture thing I like to share with our advisors. This isn't fun, but it happens. You can see you have corrections, you have bear markets, you have 30% really bad bears, even worse. So it's just some interesting data since 19. What did I go back to? I guess going back to World War II that these things happen. And again, no, we didn't think we'd have a bear market this year, but we did think a 10 to 15% pullback made sense at some point. And here we are. One more on this. I didn't share it, but one more, and then we can chat. When you're down at least 15% for the year at some point during the year, do you ever get back to positive? It's happened 3 times, right? 1982, 2009, and 2020. And there's a bunch of other times, I don't know how many, like 15 or 20, that clearly were down this much and did not get back to positive. Call me a glass half full type of person with all this negativity. If you get any good news on trade, a little bit more good news on trade, maybe we can avoid a recession. Yes, there's weakness. Look at initial claims. I mean, it's hard to have a recession if initial claims aren't spiking. We're not seeing that, and I get it. We're not seeing it yet. That can change, but the real-time data that we're seeing, we're still not. We just put the recession in the under category, and with all the negativity, maybe we can have again a pretty significant bounce still before all is said and done. All right, that's it. I'm done. I'm going to take a breath. What do you guys think? How did I do?
Ryan, so much to digest here.
I know. Throw it all in there. Sorry.
Part of me thinks that, yeah, we had we've had the 19% correction, whatever you want to call it, and now we're starting to come out of it. The market's starting to see some clarity here. The White House has backed off on their hardcore stance here on tariffs, with obviously the 90-day kick the can down the road, but also, talking about possible exemptions. So, I mean, all that is good news. The one thing that concerned me slightly here, not even slightly, it concerned me a lot in your presentation is the US dollar. With that slide that you showed where yields going higher and US dollar going down hardly ever happens or never happens, you said. And
well, at least in
I've got some thoughts on why that is happening. Is it, and maybe it's not your place to say why that is happening, but what does that mean? When you've got the yields going higher, US dollar still going down here, why is that concerning to you? I'm going to ask you first.
Let me pull up the slide here. Did I share? What
am
I sharing? I'm sharing the wrong thing. Screwed that up. Well, anyway, okay, yeah. Well, let's just talk about it. I'll take forever to figure that out.
You flagged it. You did a slide.
Yeah.
On it,
so exactly. So listen. What I've learned in my career doing this for 26 years or so is you can take a lower dollar, you can take a higher dollar. Market can go up or down on either of them. It's when you get those big swings, and obviously we are seeing a historic swing in currencies across the board, specifically the United States. I mean, some people point out, well, the dollar is back where it was in September. Is that big a deal? Stocks are back where they were. I don't exactly know where, probably late last year or early last year, because they pulled back too. So is it just a reset? Is it just this? Is it just that? One of the things that stood out to me in March of 2020 was stocks were down, bonds were down, gold was down. Go look it up. Everything was down initially on COVID, except the US dollar, right? So that was a significant crisis, obviously, shutting down the global economy. Worried if we're all going to make it. But they still bought the dollar, okay? They weren't buying butter. They weren't buying bullets. Maybe they were. They're also buying the dollar. We're not seeing that. Now, did we just lose the world's reserve currency? I mean, that's the big question. I don't have the answer here. That's something we're wondering. I would like to think in anyone's lifetime, listen to this, we will still have the world's reserve currency. But clearly with some of these policies that have really upset the apple cart, it is what it is. We're seeing that. Now, I will say this, people saying, I think China owns 750 billion of our bonds. Now, that's probably old data. Who knows what it is now? And the big question is, are they just dumping our bonds? Is China dumping our bonds? We'd say no, we don't think so, because it's kind of a double-edged sword. They dump their bonds. You know what happens? The yuan goes up. You know what happens? The yuan goes up. That doesn't help China. So they're kind of made a deal with the devil, if you will. Not the word the devil. I don't want to come off like that, but they made a deal with the devil. If they sell too many bonds, it might hurt them. So I'm not so sure China's the one dumping. We just had some really impressive bond auctions the last couple of weeks. Now, I don't know who was doing the buying. They said foreigners were. Maybe the Fed was opening up the coffers. I don't know. But we had some decent bond auctions the last 7 days, give or take. But to get to your question, Dennis, to answer it, see the way I do this, I just talk forever and never answer the question. I don't know. I mean, it is worrisome what's happening, because in a crisis, you shouldn't be seeing this. And I guess as investors, you know what? It's my job as a steward of assets to make sure the models and the money that we run for our Carson partners and their clients is the best that we can do. And that's why, again, we thought the dollar might go lower. No, I didn't think it'd do this. But as we can invest in gold, invest in international equities, still own some bonds. I mean, listen, bonds are up, I think, 1 or 2% for the year. It was a lot more this time 2 weeks ago. But that's still better than the S&P, which is down 8 or 9, and a lot of other groups down more. So you can still be diversified. You can still do some different things. But these are some big questions that are going to take a long time to get answered. And the fact that dollar's selling off in a pretty big crisis is something we haven't seen. I don't know. I don't even know the last time we saw something like this. Maybe I hate to say never, probably somewhere in history. But it is pretty concerning, the weakness in the dollar with this global calamity coming. So again, let's just diversify, and we can add other things around the world if the U.S. isn't going to be as strong. That's my answer.
Joel's on mute.
Ryan, I wanted to get one thing in here before you go.
Figures Ryan Day, spring game. I was wondering where we're going with this.
Huh.
No. The sentiment, like 23, 24, different. I mean,
Mhm.
you show extreme fear, you show extreme greed, the middle, the brown. I just think right now, extreme caution is is the way I think investors should. I think we're really at such an important point here. I mean,
Yep.
with rally and everything, and I could be convinced, but just technically speaking, where we're at, 700 points off that low.
Yep.
I'm just praying we clear these levels. I'm
Mhm.
praying that we get back over 5,500. But to me, it's like extreme caution. What
Mhm.
is that? Am I being too cautious, or that's why I just don't think this getting back to scratch on the year and things is going to happen. I just
Mhm.
think the investors are like, wow, last week that's just crazy, man. I was down
Yep.
so much money. S&P under 5,000. What if it goes to 4,500 or 4,000?
Mhm.
Is that am I being too extreme here?
No, I think you're doing a good job thinking about all the potential scenarios. I mean, I guess we'd be in the camp. We don't think it's going to get hopefully not going to get 4,500. But again, there's all these different scenarios, and I that's why I watch those credit spreads. If credit spreads get above the 22 highs, then maybe that means the economy is really in trouble. Maybe it means a recession could be well over a 50% chance. I saw some of the betting sites had 65% chance of recession a week ago. Then it dropped to 40%. Then it did this and it did that. But the reality is the market's pricing in a lot of ways a potential recession, which as I showed, you get worse bear markets when you're in a recession. So we'll just have to see how the economy can hold up. I mean, the one positive, because you brought up some negatives and they are real. The consumers truly are in pretty good shape historically. And I get it, all the debt that's out there, and I get the lower 50%. We understand all those things, but there really is a lot of equity, and corporate America has been in good shape. As we were promised a recession a couple of years ago, so corporate America is pretty lean, pretty thin. So if we went into a recession, maybe it could be fairly minor, like we saw in 1990, one of those. And at the same time, I mean, a lot of this could change in a hurry with a couple tweets. I mean, that's the honest truth. That's why, you look at the MOVE index, look at the VIX, all this uncertainty out there. It could change. Now, I mean, let's not forget. I mean, President Trump, I think, what did I hear? He was trying to buy the famous piano from Casablanca, like in the late 80s, right? And he was going to do it. And then at the last second, some Japanese billionaire swooped in and did it. He was on, Trump goes on Diane Sawyer that night, starts complaining about all the stuff around the globe. Need to have tariffs. That's where it all started. Apparently he tried to buy a piano, and that made him mad when he didn't get his Casablanca piano. Where's I going with this? I don't even know where I was going with this. I'm going somewhere with it. I don't know. Anyway, it's a funny story. But the reality, that's what it was, tariffs. But the reality is with all these tariffs, if there's enough pain. Oh, no, here's where I was going with it. Sorry, I love that story about the piano. If I was going with it. He's been talking about tariffs forever. Okay, they go on at 12:01, a couple, 6-7 days ago. And less than 13 hours later, they said, nah, sorry about that. We're going to give a 90-day extension back to 10% across the board, except for you, China, because we don't like you very much because you're not playing nice. And then, so it's just, I don't know. It is so wild that was how quickly we pulled back, but that's where the bond market remained undefeated. Stock market threw a fit. You could argue this is a cousin to 2018, and a lot of us remember that. Everybody remembers 2018. The first tariff started on washing machines back in February 4th, 2018. Stock market had one of the quickest 10% corrections ever. Sound familiar? We just had one of the quickest 10% corrections ever. But then it rallied back to new highs by September. October did okay, November, whatever. And then December happened where it wasn't really about tariffs at all. It was all about the Fed. The market threw a big fit because the Fed came off more hawkish. And as a lot of us remember back then, we had almost a bear market of 20% correction in 4 days. I mean, until the 26th, the day after Christmas of 2018, market bottomed. And then the second or third day of 2019, the Fed pivoted and said, our bad, sorry. We'll become dovish if that's what you really want. And we were off to the races. So the market threw a fit and got what it wanted. You could argue the bond market threw a fit a week ago with the 10-year up around 5%, and President Trump had to kind of pull back a little bit. We don't know. I mean, these are scenarios and history, and it's kind of fun to remember where we were, where we might go. But as a glass half full person, we are overweight equities, but it doesn't mean we're all in Mag 7. Trust me, we're not. We've got low vol. We've had low vol for a while. I mean, you can invest in some things that might do okay. In fact, we'll do okay, even if we get that 4,500 you're talking about, Dennis. I don't think we will, but there's some ways you can.
It was me. It wasn't Dennis. I was just doing scenario.
Oh, Joel. Sorry.
Scenario. Yeah. Don't put Dennis.
I'm throwing Dennis under the bus. That's terrible.
No, now I'm looking at 7,500 after talking to you. I mean, I bet you I could get some. No, I'm just joking. Ryan, I can't thank you enough for the information, the balanced perspective that you give on the markets. That's why we have
Thank you.
pre-market prep, and that's why we're just trying to educate investors. And man, you do an incredible job of it. Thank you very much, and we'll be dialing you up for next month.
Guys, I appreciate it. Thanks for all you do for the industry and helping people try to make sense of all this stuff. It doesn't always make sense, but that's why we're doing our best, and no one has all the answers. But this show usually does. So just thanks for having me. I'll see you guys in about a month. All right. Thank you.
All right, thank you.
Thanks, Ryan.
Ryan Detrick, Chief Market Strategist over there at the Carson Group.
So good. So good.
OT, Dennis, we're OT here, overtime.
Yeah, so just final thoughts. Look, when we talk about Contrarian, we're down 35 handles when Ryan starts talking. He just talked the market up 30 points now. Obviously, it wasn't all Ryan here, but we're just saying this is the type of market we're in. Selling rips, buying dips. You did it again 30 minutes ago and you're making money. I mean, this is just the market that we're in. Panic. This isn't the market really. I don't feel like it's panic here. Again, maybe it's going to be a White House tweet or something that's going to make the whole market panic here. But I feel like we're past the panic stage. I know Ryan showed extreme fear at 3. I feel like we're past that extreme fear. I don't feel the extreme fear out there anymore. Maybe it's going to go back to that, but I feel like we're just kind of range bound here now where we're kind of through a lot of the tariff tantrum. We can see that there is a Trump put. This has been the concern here for a while, that markets were saying the Trump put is dead, that Trump absolutely doesn't care about the stock market now. And, if the stocks fall, so be it. We can see that is not true, or at least is not true in the bond market, to Ryan's point, because when the bonds started getting hit last week, we absolutely saw the White House buckle under that pressure. So I think we do have a Trump put in here now. That is calming to investors. That is calming to institutional investors. That makes me want to buy stocks on dips. Are we going to get a big dip again? I don't know, but there's still a lot of stocks that are pretty beat up. So I think we're still just in a range-bound market until the next White House tweet or the next, social, Trump tweet.
Okay, that's it for today, folks. We got to hop over to the STN room. Join us. A lot of great content over there. Back again tomorrow morning. You guys know where to find us, 8 a.m.